If you live in the UK and want to start investing in the stock market in 2026, but you feel confused, scared, or even just a little bit overwhelmed, then this video is going to change that. In the next 15 minutes, you'll learn exactly how the UK stock market really works, the best tax-free investment accounts like ISAs, and SIPPs, which platforms beginners should be using, a safe and simple investment strategy, and the biggest mistakes that absolutely destroy a beginner's money. This is your complete roadmap designed specifically for UK investors in 2026. Just a quick reminder, this video is for educational purposes only and is not financial advice. Let's be honest, keeping your money in a savings account is no longer enough. In 2026, inflation is quietly eating away at your savings. Your cash is losing value every single year, and the cost of living just keeps on rising. Meanwhile, people who invest are becoming owners of real companies. They're earning dividends and they're growing their wealth over time. Historically, the stock market has been one of the most powerful tools for long-term wealth creation. And the best part? You don't need to be rich, you don't need to be some kind of genius. You just need to start early and stay consistent. The power of compounding is incredible, and the sooner you start, the more time your money has to grow for you. Think of it this way. Every day you're not invested, you're missing out on potential growth that could secure your future. So how does the UK stock market actually work? It's much simpler than you think. The stock market is just a place where people buy and sell small pieces of ownership in companies. When you invest, you can buy different things. First, there are individual stocks. This means you own a tiny piece of a single company like BP, Unilever, or HSBC. This approach carries higher risk but also has the potential for higher rewards. Second, and this is what I want you to focus on, are ETFs, or exchange-traded funds. An ETF is amazing because it owns hundreds or even thousands of companies all at once, bundled into one single investment. This automatically means less risk and more stability, which is perfect for beginners. Third, you have index funds. These are similar to ETFs, but they're designed to track a specific market, like the FTSE 100, the FTSE All-Share, or even the entire global stock market. Honestly, about 90% of beginners should start their journey with ETFs or index funds, not by trying to pick individual stocks. It's the smarter, safer way to begin. Now, let's talk about the UK's biggest advantage, something that puts us ahead of many other countries: tax-free investing. First up is the Stocks and Shares ISA. An ISA allows you to invest up to £20,000 every single year with zero tax. That's right, zero. This means no capital gains tax on your profits, no tax on any dividends you receive, and no income tax. It is hands down one of the best wealth-building tools available in the entire UK. For beginners, this should absolutely be your first investment account. It's a no-brainer. Next, we have the SIPP, or Self-Invested Personal Pension. SIPP is designed specifically for long-term retirement investing. The benefits are huge. The government actually adds tax relief to your contributions, you get incredible long-term compound growth, and it's extremely tax efficient. The only downside is that your money is locked away until you reach retirement age. So here's a simple rule to remember: an ISA gives you flexibility, while a SIPP is for retirement. The best strategy for most people is to start with an ISA. Once that's up and running, you can think about adding SIPP later on. So where do you actually buy these investments? You need a broker, which is just the platform you use. A good UK broker should be a few key things. It must be FCA regulated for your protection. It should have low fees because fees are a silent wealth killer. It needs to be easy to use, especially for a beginner. And most importantly, it must offer the ISA account we just talked about. Some of the most popular beginner-friendly platforms in the UK include Trading 212, Vanguard Investor, AJ Bell, and Hargreaves Lansdown. Now, I can't stress this enough: always understand what you're paying in fees. A small percentage might not seem like much, but over decades, high fees can literally eat away tens of thousands of pounds of your returns. So do your research and choose a low-cost platform. How much money do you actually need to start investing? So many people delay getting started because they think they need thousands of pounds. That is completely false. You can start with as little as £25, £50, or £100 a month. The real secret is consistency, not the amount you start with. Investing a small amount every single month is a strategy called pound cost averaging. It's a brilliant technique because it reduces your risk by smoothing out the ups and downs of the market, and it removes emotion from your decisions. You're not trying to time the market. You're just consistently building your wealth over time. So forget about having a huge lump sum. Just start with what you can afford and commit to doing it regularly. Okay, let's pull this all together with a simple beginner investment strategy. This is a low-stress, professional approach that is perfectly suited for beginners. Here's a sample portfolio you could consider. 60% in a global ETF. This gives you exposure to thousands of companies all over the world. 20% in a UK index fund, like one that tracks the FTSE all-share. This gives you a solid footing in your home market. 10% in an emerging markets ETF. This adds a little bit of growth potential from faster-growing economies. And finally, 10% in either bonds or simply held as cash. This adds stability to your portfolio. Why does this work so well? It's diversified, it's focused on the long term, it's incredibly low effort, and it's a proven approach used by professionals. With a strategy like this, you don't need to check the market every day. You don't need to be constantly trading. You just invest, wait, and repeat the process. Smart investors understand trends, but they don't get caught up chasing hype. As we look at 2026, UK investors are keeping an eye on a few key areas. Things like renewable energy, artificial intelligence and technology ETFs, healthcare and infrastructure projects, and solid dividend-paying companies. These are sectors with strong long-term potential. But remember the golden rule: trends change. But discipline doesn't. Your core strategy of long-term, diversified investing should always remain your foundation, regardless of what's hot in the news. Finally, let's cover the biggest beginner mistakes that you need to avoid at all costs. First, not using a stocks and shares ISA. You'd be giving away free money to the taxman. Second, panic selling during market drops. Markets go up and down, it's normal. The worst thing you can do is sell at the bottom. Third, chasing social media hype stocks. If it sounds too good to be true, it almost certainly is. Fourth, overtrading. Constantly buying and selling just racks up fees and rarely beats the market. And fifth, having no long-term plan. Successful investors are not lucky, they are patient. They have a plan and they stick to it. If you're in the UK and you want to achieve financial security, investing is no longer optional in 2026. It's essential. Start small, stay consistent, and always think long-term. If you found this video helpful, please give it a like and subscribe for more UK investing guides. And comment ISA down below if you want a detailed breakdown of a beginner portfolio. Thanks so much for watching.